Good morning, everyone, and welcome to our next RSM webinar. My name is Neil Hughes. I am a tax director at RSM South Africa, and the topic of our webinar today is the new expat tax laws. Now, the expat tax laws is just a common terminology for what is in fact the tax exemption rules applicable to employment income. Now, we're going to try and understand with a little bit more clarity who is going to actually be impacted by these new expat tax laws. Now, there's been a lot of confusion and panic in the public regarding this new amendment. And I do personally believe that a lot of that confusion and panic is unfounded. And that's what we're going to try to do is just unpackage exactly what these rules are, who is going to be impacted, and where the confusions are being misdirected. As far as the topics for the webinar today are concerned, I've broken down a brief agenda to cover exactly what we're going to be looking at. And what we're going to be starting off is not diving straight into these tax exemption laws, but rather start with a degree of a basic refresher on some core concepts that are quite important to this overall topic. Now, those refresher aspects that we're going to be looking at is firstly the issues of South African tax residency. And then we're going to be breaking down the gross income definition. And what will become more clear as we work through all of the content is that those key concepts are very important to be familiar with and to have at the forefront of your mind as you go and look to apply these new expat tax laws and understand where the exemptions do or do not apply. What we'll then do is take a bit of a closer look at the current legislation and the working of the current tax exemption rules. We'll then try and understand with a bit of clarity why SARS felt the need to make amendments to those laws, and then we'll look at exactly how the new tax exemption laws read. Then what we're going to branch out onto is something that is not directly related to these new tax exemption clauses, but very closely related concepts that have become very topical when looking at this aspect. And that is specifically the issues regarding a change of your country of tax residence, as well as this concept of financial immigration, and try to help you understand how that interplays with this overall topic. And just to close out today's webinar, we've set out a fairly simplistic practical example. So for those individuals that may be impacted by these new laws, they'll get a better feel for exactly how this will impact them in the pocket. What we must just please bear in mind when working through this topic is that every single taxpayer's personal circumstances are different to the next person. And it's impossible to try and give you a key solution here that will solve everybody's circumstances. So it's important that once you have these core ground rules laid down for you, you would have to apply to your personal scenario. And dependent on the level of complexity in your personal affairs, that's when you need to understand that there may be a need to consult with a professional to work through your intricate scenario. So let's start off with our refresher by revisiting some basic concepts and topics. The first is to understand who is a tax resident of South Africa. Now, we're dealing with natural persons here. So for a natural person, it is firstly an individual that is ordinarily resident in the Republic. Now, you might ask the question, what is it to be ordinarily resident? I've included some commentary here from one of our learned judges on the slide, so you can read through that. But the crux of what is being stated is from case law, is that your country of ordinary residence is the place where you will return to from your wanderings. It's basically the place where your personal and economic ties are closer. Now, that could refer to things such as understanding where is your family situated? Where are your investments made? Where does your retirement savings sit? Now, for certain people with fairly limited complexity in their affairs, that may be very clear to identify where is the country they will always return to from a wandering to another jurisdiction. But in this day and age where the world is becoming much smaller and it's much easier to make investments cross-border, these concepts do sometimes become a little bit tricky, and that is where you may need to consult further to assess how certain or uncertain your position may be when determining your country of ordinary residence. The secondary aspect under which a person may be seen to be a tax resident of South Africa is if they meet the requirements of the physical presence test. Now, the physical presence test is a rules-based approach that has actually been written into the Tax Act. And we've laid out for you on the slide the fixed criteria for the number of days that a person must be present in South Africa in order to be deemed to be a resident. Now, that's just important for you to note. This physical presence test, it's a rule under which a foreigner may be deemed to be a resident of South Africa by virtue of their extent of presence in South Africa. And you must see that it rolls over a 6 consecutive tax year period. Now, you mustn't be confused and think that by virtue of the fact that you've been outside of South Africa for those number of days, that it deems you to then be a non-resident. The test doesn't work in that basis. It's only a methodology of deeming a foreigner to be a resident in South Africa. And then the next element of the rules regarding a tax resident of South Africa is that there is an exclusion, whereby it states that the tax resident of South Africa does not include any person that is deemed to be exclusively a resident of another country in terms of a double tax agreement that is in place between the two countries. Now, when an individual's affairs start becoming more complex and we apply the terms of these double tax treaties, you need to be very careful. And when planning to go to another country that does have a DTA in place with South Africa, you should be planning in advance whether this may have some form of negative impact to you. For example, taking a decision to rent out your primary residence in South Africa when exiting the country on a short-term wandering. Let's put it into a practical example. An individual wants to go spend a medium-term sort of secondment or assignment overseas to gain foreign knowledge, foreign experience, and earn some foreign earnings, which they can bring back into rands at hopefully a favorable exchange rate. While he's overseas, if he decides to rent out his home sitting in South Africa, that may well have an impact when you apply the terms of the tax treaty with that counter country and could trigger unforeseen circumstances. So it's just important to appreciate in planning an assignment where you're traveling outside of South Africa, you need to be aware of all the different rules that may have an impact on your personal scenario. The other fundamental concept that's important to understand is that of gross income. Now, gross income is fundamentally different whether a person is a tax resident or a non-resident of South Africa. And that's why we focused on those tax residency discussions first. So in the instance of a person that is a tax resident in South Africa, gross income would include that person's worldwide income. So be it investment income offshore, foreign trade results, foreign rentals, all of your worldwide income is brought into the tax net in South Africa. And that obviously applied from the point in time when South Africa moved to a residence basis of taxation. Now, the distinct difference when you're referring to a person that is not a tax resident of South Africa, their gross income in South Africa will be limited to income that is from a source within the Republic. And these core concepts you must just keep a degree of familiarity with as we start talking through the tax exemption rules. Now we can move into the current tax exemption rules that sit in the Income Tax Act. So these expat tax laws, as they are commonly referred to, is actually the tax exemption that is housed in section 10102 of the Tax Act. And I want to break down this exemption wording for you so that we can appreciate how it applies and understand clearly who and how it works. So they shall be exempt from tax any form of remuneration received by or accrued to any employee. And we just need to pause there and put that in perspective. This exemption clause in the Tax Act only applies to remuneration earned by an employee from an employment relationship. So you should not be confused and think that this exemption is going to extend to investment income, rental trade income, or any other sources of income. It's purely focused on remuneration from employment. Moving on, it must be in respect of services that are rendered outside the Republic. And those services outside the Republic must meet a fixed days count criteria. So this individual must be outside of South Africa for a period exceeding 183 full days in any rolling 12-month period. And within that period that you've been outside the country, there must be a continuous time period outside the Republic exceeding 60 full days. And then the final aspect is that the services were rendered to earn that remuneration during those periods outside the Republic. So this is all the very fixed criteria to be met so as to qualify for that remuneration related to the time worked outside of South Africa to be exempt from income tax in South Africa. And just to break it down, it sometimes helps with a simplistic example. If we had an individual working on some form of secondment or assignment outside of South Africa, and during the course of the year, let's assume that the days count were met for the time outside of South Africa, and in aggregate, the individual worked outside of South Africa for 9 months of the year and worked in South Africa for the remaining 3 months. When looking at this person's tax position, only the earnings for the 9 months when he was physically working outside of South Africa will qualify for the exemption. But for the 3 months when he was rendering those services inside South Africa, that would still be normal taxable income. Now that we should have the clearer understanding of the current law, we can try and understand why was there a need to try and change these expat exemption tax laws. So South Africa has agreements in place with a number of countries for the avoidance of double taxation. These are what are commonly referred to as the double taxation agreements. Now, dependent on the specific circumstances of each case, with specific reference to employment income, these double tax treaties may grant a limited taxing right in the source or host country. Alternatively, if certain other criteria are met in terms of the DTA, what it could do is grant a sole and exclusive taxing right in the residence country. So that's where these DTAs aim to align who has the taxing rights on employment income. But what is outside of the tax treaty is that a resident state may still have a taxing right. And to the extent the home country, in this case, let's treat South Africa as the home country, to the extent there is still a taxing right on the income, it will provide relief for any foreign taxes that are deducted and paid in a foreign jurisdiction. And the methodology of providing that relief is in terms of the Section 6 quad tax credits. So what you could see is there may end up being a position where there is a taxing right in the host or source country where the individual is based, but the home country still has this taxing right. And that is an indication of a position of double taxation. So that is the reason why the current Section 10102 exemption exists in the Act to try and escape that double risk exposure. But the problem comes about is by having this exemption in the Income Tax Act, it creates an opportunity for double non-taxation. And the reason this would come about is where an individual is working in a host country that imposes either very little or even no taxes on employment income. Now, that position of double non-taxation is obviously quite contrary to the concepts being attacked by the BEPS projects. That is the base erosion and profit shifting rules, where they're trying to ensure that people aren't able to manipulate their affairs and the jurisdictions where their income is taxed. So with that as the reasoning being provided from the authorities, we now have the new Section 10102 exemption laws. Now you will note, if you take the time to read through the detail, that this looks exactly identical to the current laws, with one small differential, which I've highlighted in blue. And all it is that there is a limit of the extent of income that qualifies for the exemption. So the workings are exactly the same. The individual must still be earning remuneration from employment. It must be working outside of South Africa for all of the required number of days. And when you meet the criteria, that income will still be exempt, but only up to the first 1 million rand of earnings in a year of assessment. So that new law is effective from 1 March 2020. So for all of those individuals who this may actually apply to, they should be aware of that their circumstances and their position may be changing from the beginning of the South African tax year that commences 1 March 2020. In applying these new rules, there's been a lot of confusion. Okay, maybe before we come to the confusions, let's just summarize. Who does this exemption apply to? It is a natural person working for an employer outside of South Africa for the required time periods, and when they meet all these criteria, the income earned will be exempt in South Africa. But with the new change coming in from 1 March 2020, only the first 1 million rand worth of remuneration will be exempt. Where an instance of confusion has come about, and an example of a scenario that has been posed to us, is where an individual has left the country many years ago. So let's work through this as a practical case where we can assume that an individual left South Africa 10 years ago with no intention of ever returning. Now that individual set up his new home in Australia, he's got residency status, he's employed for and working for an Australian company, earning a salary in Australia. The panic and the confusion that's been coming back to us is that this ex-South African suddenly thinks that now SARS will be in a position to attack him on his Australian salary and make him liable to pay taxes in South Africa. But what we must do is take a step back and go back to those core concepts we were talking about. In this scenario, this individual has already ceased to be a tax resident when he left the country 10 years ago with no intention of ever returning. Now, as a non-resident of South Africa, that Australian salary will not be included in the gross income definition in South Africa. Remember our definition? Gross income, in the case of a non-resident, is amounts that are sourced within South Africa. So, as this individual does not even have any inclusion into his gross income in South Africa, there is no need to even apply this new tax exemption clause. And as a result, the limitation of only the first 1 million rands worth of earnings is absolutely irrelevant to the individual in this sort of circumstance. And I think that is where a confusion has come about. And to bring it full circle, this reiterates why it's so important to understand what is your country of tax residence. So again, now we're branching away a little bit from the specifics of the tax exemption clause in the Act, but looking at the commonly related concepts where there's close relationships to this overall topic. And that is the next point is understanding what happens when you change your tax residence. Now, it's important to understand that when an individual makes that conscious decision to leave South Africa and break their tax residence, that does trigger an event. And the nature of that event is that it is a deemed disposal of your worldwide assets. Now, the reason this is in the laws is it is basically SARS's last opportunity to tax a person on their accumulation of wealth. Because once a person has exited the country, you've already seen the gross income definition changes significantly. Now, the only exclusion to this deemed disposal exposure is related to fixed property that is situated in South Africa. And the reason for that exclusion is because a non-resident of South Africa will still be liable to capital gains tax on fixed property that is situated in South Africa. And that is why, if there is fixed property, that gain event will always be deferred until the actual disposal happens. Now, this exit tax on ceasing to be a resident, that's how it's commonly referred to, is very onerous on a taxpayer, because you must understand that the individual is not receiving any proceeds to fund the payment of the capital gains tax. You would have to fund that out of cash savings. And that makes it very clear to advise an individual when planning to emigrate or to cease to be a resident of South Africa, you need to understand whether this triggers a tax exposure in its own right, and you need to be able to be prepared to manage the burden of that tax charge. Another common problem that we have encountered in terms of our dealings with clients is that where an individual left the country some time back, they may have never declared this deemed disposal event when they should have, meaning that they are now in a position of non-compliance. And you can't just overlook that and think, well, how will SARS catch me because I'm no longer in South Africa? Circumstances may come about that the person is, for argument's sake, needing to take receipt of an inheritance from someone's estate in South Africa. And the only manner in which they can take receipt of that offshore is if they go through a financial emigration process. And as part of that process, one of the requirements is to obtain a tax clearance certificate from SARS for immigration purposes. And in going through that process, SARS would perhaps have the opportunity to investigate the affairs, and it could come to light that there's been a default. And in the event that SARS find this out before the details are declared to them, they can hit you with horrible understatement penalties. So that is what people must just understand as in terms of the repercussions of this exit charge. The other common phrase that is thrown around a lot when talking about this overall topic is that of financial immigration. Now, we must understand that a person's tax residency is a matter of fact based on their personal situations and circumstances. Financial immigration is not in any way a tax concept. This is rather a financial or a banking terminology. Now, financial immigration encompasses the process of making a formal application via an authorized dealer, such as a bank, to place on record with the South African Reserve Bank the fact that a person has now left the country, and it changes their status from a banking perspective. Financial immigration is perhaps a methodology that a person could look to use as a means of support to the fact that they have ceased to be a resident for tax purposes. Now, the reason why this could help to confirm the fact that a person has left the country from a tax perspective is because in the MP336B form that is submitted to the Reserve Bank, details such as your date of departure and the counter jurisdiction where you have now taken up residency will be declared in that form. And that is why people sometimes note that if you have a degree of doubt or uncertainty to be able to prove the fact that you are no longer a tax resident, that is why this may be a method of supporting it. But it's important to note that it is not a requirement to go through a financial immigration process when you cease to be a tax resident. That is dependent on a person's circumstances and the needs to extract wealth out of South Africa. I hope that has all brought this all into a degree of practical context where you can appreciate how the tax exemption laws apply and who they apply to, and the common surrounding areas of concern and panic and confusion. But I think what will maybe help us round this all out is if we now go through the practical example. So let's work through this scenario. Let's assume we have an individual, Miss X, who's a 38-year-old South African rendering employment services in Dubai. Now, in addition to funding her own living costs, she actually sends funds home to her elderly parents in South Africa to meet their needs. Let's assume for the practical scenario's case that Miss X does not derive income from any other sources and she does not qualify for any additional tax deductions. So based on that circumstances, let us analyze what would Miss X's tax position be both pre and post the amendment of these tax exemption laws. So in this table, I think it lays it out very clearly. If we look in the instance, we take the assumed level of foreign earnings, converted into rands, we have earnings of approximately 1.6 million rand. Now, if we start with the first column, under the current laws, because Miss X in the scenario is spending her entire time rendering the services outside of South Africa, she earning remuneration income from employment, she will meet the criteria of Section 10102, and all of those earnings will be exempt. meaning she has no taxable income in South Africa and similarly no tax payable. If you fast forward that to 1 March 2020 when the new rules kick in, at your tax exemption line, you know now the level, the exemption would still apply, but the extent of the exemption is only limited to the first 1 million rand of earnings. So it's quite clear to see that Miss X in the scenario will now sit with taxable income of approximately just over 600,000 Rand, which after applying the indicative tax tables where we have applied the 2020 tax tables, she will sit with a tax liability. Now in this scenario, if you put yourself in this taxpayer's hands, you're suddenly going to be out of pocket to the tune of approximately 160,000 Rand. Now this starts making it clear why people in these sort of circumstances need to prepare for what these laws mean to them and the financial impact that they may be suffering. Now this scenario worked off an individual in Dubai where there were no foreign taxes on that employment income in the host country. What is of course different is if an individual is working in another jurisdiction such as the UK where there are proper taxes being deducted from the earnings. The scenario will be somewhat different and the impact should not necessarily be as harsh. That is because you will be entitled to claim a foreign tax credit for those foreign taxes paid in the source or host country. It should be clear that when it comes to doing your tax return with these additional disclosures and claiming things such as foreign tax credits, where you need to be able to support it accordingly, work out and apply the workings of Section 6 Quat of the Income Tax Act, your affairs are becoming somewhat more complex. And this is where I just need to urge taxpayers to understand where is there a limit on your personal abilities to handle your affairs when it has complexities of this nature. And that is when you maybe need to understand it is time to approach a reputable tax practitioner to actually assist you with these disclosures. Because if you get that wrong in your tax return, it will have negative consequences and you will no doubt end up being worse off in your pocket. I really hope this quick summary has achieved its goal of trying to round out these tax laws, understand more simplistically who it applies to, what's the nature of the changes, and to appreciate when you need to actually seek advice. And I do hope this has been helpful, and take care and have a good day. Goodbye.